Good morning, everybody, and welcome to the weekly analysis session for Monday, the 7th of September 2015. We've just returned from an extremely successful academy up in Century Cove in Queensland there. It was a slightly smaller academy than previous years, but feedback from the group by and large was that very successful. And despite the slightly smaller numbers than we had in previous years, some very nice feedback suggesting that it was the best academy yet. So thank you to all those clients who came along. Certainly had a good time mixing with everybody, getting to know everybody a little bit better on an individual level, talking a whole lot about trading methodology, the psychology of trading, certainly a very important aspect of it, market risk, and all things fundamental with Jeff Saffer. We had our guest speaker there, Stuart McPhee, who certainly was very interesting in terms of his past experience, a person from a military background, talking about the way that he trades, and in particular the mindset that he brings to his trading, both in the FX markets and in the equities markets. So a little bit of a background there for those of you who couldn't come along to the academy. All right, the disclaimer: the content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, nor particular needs. So before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances. All right, as per usual, the portfolio management, we're going to have a look at what's happening on the markets as we speak. Certainly extremely volatile at the moment in both the Australian and the US markets. The US market closed tonight. The Australian market will probably dilly-dally around on the back of no strong lead other than what happened on Friday night in the US, which was fairly much a bit of a down day over there. We'll go through and have a look at some specific setups and some Q&A. At this point in time, the Australian market, the ASX 200, we are in very high market risk at this point, meaning that we need to apply a 20% market risk multiplier. In the US, we are also in very high market risk as we speak, and as a result, apply a 20% market risk multiplier as well. Very high market risk, so a 20% market risk multiplier. So if you're splitting your capital between those two markets, therefore you are splitting your maximum allowable drawdown, assuming that you're allowing yourself a maximum drawdown of 15%, then half of that you allocate to your Australian portfolio, which would mean under low risk conditions that you're allowed to have 7.5% exposed as value at risk. We're at very high market risk now, so we're only allowed 20% of that figure, which is 1.5%. Exactly the same in the US. The other 7.5% that you're allowed to expose as value at risk in a low market risk conditions, we're only now allowed to apply 20% of that, and so therefore 1.5% of your allowable capital is to be exposed as value at risk in that particular market. Those of you who are choosing to scale out because it's a very high market risk are looking for targets of 1-to-1 in both the ASX and the USA. This week, in terms of setups, etc., stop outs, trail stops, we'll go through those and have a good look at and see if we can find what's been going on in the market and see if we can make any sense of it at this point in time. So what I'll do is I'll bring over beyond charts at the moment, and what we might do first and foremost is go through and have a look at our indices. We'll start off with our XJO. That's our market there at the moment, and certainly for a long time we've talked about the relevance of 60 on the stochastic. Obviously the stochastic needs to move through 60 to get down to those lower levels, but certainly once we get down to 60, the propensity for the market to slip away quite quickly certainly does increase. Interesting to note that the stochastic, it's a lagging indicator, that we were in extreme risk around about 2 weeks ago, and since then, with this little bit of a movement back up, it's just dragged our stochastic back up into the very high market risk as we speak. Certainly no significant changes in terms of what we're thinking about the markets at this point in time. It does allow you to have a slightly higher value at risk, but again, you have to look at that in the broader context, what's happened with your portfolio over the last few months, and see whether or not it makes sense to be adding any trades to your current requirements. Certainly at this stage, not in any hurry to be adding anything terribly much on either of the portfolios. I think this market's still got a lot of work to do to sort out which direction it's going to go over the next few weeks, and into certainly September, October time, when traditionally they've been fairly volatile months on the markets. That's the XJO. Let's just pop over and have a look at the S&P 1500. And again, at this point in time, you'll see if we just move over to the left-hand side there a little bit, a couple of weeks ago we were down about 5%. Since then we've actually come off a little bit lower now, and certainly pretty classic 3-bar reversal there over the last 3 days of last week, which is not particularly a good sign there. From a price action point of view, it would have been nicer to see a white candle on the end there. Certainly the market's not looking terribly exciting on the upward side at this point in time. Again, that little bit of a move up last week has just prevented us from going into extreme market risk territory there, still maintaining a very high risk at this point in time. And certainly one of the things we talked a little bit about the Academy is that, the fact that this whole market very much going sideways, and yet our market risk indicator moving more to the downward side. So basically what we call a level of divergence between price action and what our market risk indicator was doing there. So that's our two markets that we primarily look at. Those of you who caught up with the macro session on Friday or over the course of the weekend, we also had a look at some of the other markets as well around the world, and none of them faring terribly well at this point in time. What I thought I might do to start with is just go through and have a look at some of the trades that were stopped out over the course of the last week. So what I might do is just bring up my list of open trades in the US. So we'll go through there and have a little bit of a look at some of those. I'll just close out some of these other charts that I had up here. And we'll just zoom in a little bit and have a look at how things have been progressing. Again, certainly US market a lot more volatile than the Australian market, and it's really interesting that over the last probably about 4 or 5 weeks that there's certainly been, obviously the US, what we've got in the Australian watch list is a smaller sample than what we have in the American watch list, but those stocks that are in the Australian watch list certainly not experiencing the degree of volatility of the stocks that are in the US watch list. The Australian stocks generally are holding up reasonably well given what's been going on with our market. So if the unusual does happen and the market does happen to turn around and rip higher, I think it's going to bode well for those stocks that are still in the portfolio. Remembering again that our trailing 3 ATR is our exit signal, so keeping it as simple as possible, and this was a concept that we really focused in on at the Academy, that a lot of people try and second guess what the market's going to do. Certainly the last couple of weeks in the US in particular, with such volatility, we've had big moves down below our trailing 3 ATR as a result of that. And a number of stops being stopped out along the way. So our exit signal when price closes below that 3 ATR. So some of the ones that did stop out this last week, ACN as an example there. Previous week, price coming down, big horrible candle last week. Well, even though it's a white candle, it gapped down a long way from $98 all the way down to around about $90 odd or $91 there. You can see. At the open, so a big gap down, still closing above the trailing 3 ATR, but last week closing below it, and as a result, our rule is when it closes below the trailing 3 ATR, we must exit, so we get out at market the following day. So ACN was one of those stocks. BC, I think, was another one. Brunswick Corp. I won't go through all of these. There's about 11 of them. They are all in the watch list. And another one there, similar sort of story where price gapped down at the beginning of the week from previous levels. Looked to go even lower. Did close above the trailing 3 ATR the previous week, but then last week just closing below, and so therefore a market exit. So if we have a look at an example of a trade like this, the trailing 3 ATR, the strong candles pulled that up. Along the way, price action here really didn't do a hell of a lot. So the end result for this particular trade, rather than losing our full 1R, we've done about half an hour on that particular trade. That's Brunswick Corporation. FDS was another one. Again, last week, throwing in an open, somewhere around about $15 lower almost from the previous week. At one stage, looking pretty terrible all the way down here at $140 odd, closing the week pretty strongly. But last week, couldn't follow through with any of that momentum. That's not surprising, really. And again, closing below the trailing 3 ATR on that one. So eking out a small profit on that. Took a little bit of time to do that. And this is why it's so important that once you get into a trade and they are moving the appropriate direction, just to exercise some patience and try and capture some of those bigger gains, so that when we get some of these really volatile moves, that it doesn't disturb your portfolio as much as potentially could. Some of the other ones there, I'll go through another couple of others. IHI. Again, last week, pretty terrible candle. I mean, you're getting stock moves here that were going from around about 120 all the way down to $100. So certainly big moves to the downward side. And whilst it did recover and close above the 3 ATR, again last week couldn't get any follow through whatsoever, closing below. And again, stopping out with on that one, they're losing a little bit more than the initial, a little bit more than half an hour on that one there. Compared to where we entered and where we left. And I'll do one more, IYH, just to go through and have a look. And this sort of volatility is just unbelievable. A stock opening at $155 odd, and then during the course of the that particular week going as far down as below 110. That's a massive move, and certainly a very scary type of move. And it's interesting, it did seem to happen, these sorts of moves tended to happen more in sector-based ETFs than anything else, which is interesting. And I know certainly with all the selling that was going on in individual stocks that make up those baskets of ETFs, that the fund managers, if you like, of those ETFs, again, having to constantly reassess the value of their managed fund, which is effectively what an ETF is. We're certainly working overtime, given all the frenzied selling during those particular periods of last week and the week before. Nevertheless, it did close still back above the trailing 3 ATR. Couldn't gather any further momentum last week, and as a result, closing somewhere again towards the midpoint between our entry and our exit, and that distance representing our initial risk, which is 1R, which for most of you will be somewhere between anywhere between 0.25% up to around about 1%, given that your longer term portfolios generally have a larger amount of capital, and so therefore exercising a smaller percentage. As a result of that, you're going to end up in this particular instance donating around about half an hour of that initial figure. Other stop outs for the week were LGF, which is Lionsgate, Netflix, a really interesting one there. Netflix certainly jumped out of the gates pretty well. We had PBJ, which is Power Beverage, Power Shares Beverages, I think it is. We might bring that one up. PBJ. Just have a look at this. I think this is one that was very volatile. Yeah, look at this. Last week or 2 weeks ago, the close at $31.95 and going all the way down to nearly $16. That is just massive volatility. in what is an ETF, which are generally, by and large, in terms of overall movement, generally less volatile than the indices that they represent. This one obviously being a sector-based ETF. Massive moves to the downward side, but at the end of the week are still remaining above the trailing 3 ATR. This particular movement here, the last candle there, just closing below the 3 ATR, that little black candle just prior, just below that trailing 3 ATR, and as such, a market exit as well. But certainly massive moves there, and very scary for anyone who's in those particular stocks. Certainly, some of the ETFs during the course of the last couple of weeks, in particular those sector-based ones, really putting in some big spikes along the way. The other stop outs, they're all in the watch list. RE was another one, and WRB and XL was another stop out. In the ASX, we had one stop out, and we'll go through and have a look at some of the Australian Opens there at the moment. Australian Open sounds like the tennis. So I'll just bring up the watch list there when Beyond Charts is all good and ready. There we go. And so CZZ, certainly in the portfolio, still performing really, really well. You'll see that we've had a number of price volume volatility exit signals. Certainly the exit signal on this one going off down the bottom there. So where that is not exactly 100% accurate. So I'll move that down to the bottom there. When that signal went off, you've still got a 42% return on CZZ, and it went off again last week. So if you didn't take some money off the table the previous week, you had another chance last week, giving you from initial entries around about just over 50% return in 119 days. That's very good money in anyone's language, so certainly makes sense to take a little bit off the table, remembering our exit rule is that once it closes below the 3 ATR, that's the end of the trade. We exit it at market. And the price volume volatility, again, using it as your discretion, but certainly that's a very sizable return in a very short space of time. So still in CZZ. The one that we did get stopped out of last week in the Australian market was Select Harvest. This is a stock that's been moving along really, really well of recent times. Has put in a number of price volume volatility signals along the way. The most recent one coming in, or there's two there coming in at around about pretty much the same sort of level. The one that fired off on the black candle there was giving us around about just over 40% return, and again in a pretty short space of time, 119 days, which I think was about the same as Capilano Honey as well. They triggered it around about the same sort of time. So taking a little bit of capital off the table there, so you're ending up with, at least on half your trade, around about a 40% return, closing last week just below that trailing 3 ATR. So all in all, a pretty successful sort of trade, and hopefully making up for some other ones that perhaps didn't carry their weight across the broader portfolio. What I might do is just go through the list a little bit. There's James Hardie. It's still sitting above its trailing 3 ATR. So no further action there. IVE, this is an ETF based on Europe and parts of Asia, etc. Still holding its head above water. Certainly still got a fair bit of work to do. GOZ, it's still got a lot of work to do at this point in time. Haven't really had much in the way of really strong white candles to continue pulling that trailing 3 ATR in upwards direction. GHC, last couple of candles, well, the second last candle, more bearish than bullish, did manage to close a little bit higher for the particular week. Last week, quite a nice candle given what the rest of the markets do. It did. So, if we can get another higher close this week, then that'll start to pull that trailing 3 ATR up. BWP, succession of lower lows and lower highs, so well entrenched in a short-term downtrend at this point. We really need to see a bit of a turnaround over this next week moving to the upside. ARB, again, thinking about what the broader market's done. This has really just sort of moved sideways more than anything, whilst our market has continued to deteriorate. Auckland International Airport, this has been a stock that has been in the portfolio for a little while, and has actually been one that's really respected its trailing 3 ATR for a significant period of time. When this was added to the portfolio, it was added at around these levels back early in the year, around about April time. But as you can see, prior to this, even this little black candle down here, I think I've gone through this a number of times before, closed above the trailing 3 ATR. So this is why it's so important to let those profits run, so that eventually when we do get some volatility in the markets, that it doesn't upset the portfolio nearly as much as if you're jumping into a trade, no sooner getting into a trade, getting out because your fear of loss is overwhelming and making you not follow your trading plan. Trading plan simply says once price closes below the 3 ATR, it's time to leave. All right, so let's go through and have a look at some of the setups this week in the US. I managed to find a couple of these despite what the market risk is telling us at the moment. So if you have room in your portfolio and you haven't experienced too much of a drawdown over the last few weeks, then that's a good thing. So if you certainly have dry capital and you feel so inclined, then there's a few setups here that you might like to have a look at. But certainly you want to make sure that you are not risking any more than 1.5% of your total capital as value at risk in the US market as we speak. So that being said, the first stock in the US, NVR, actually got quite a lot of white candles in this stock. So naturally, its relative strength is very, very high. So it's been outperforming over all three time frames for quite a significant period of time now, while the rest of the market has continued to fall away to the downward side very, very quickly. Nice candle last week. So as such, all we need to do, at this point in time, is break through our last medium-term peak. I'll just zoom out so you can see where we are. So we are at all-time highs. So from that point of view, we have an on-stop order at $1,584.56 with a limit to $1,600.40. We have a protective stop outside of 2 ATRs and coming in at least 0.5% below that last medium-term trough. That has a protective stop in there at $1,422.96. It's a fairly costly share, that one, $1,584. So whether you would buy that outright or on a CFD, you would have to pick and choose. But certainly in terms of price action, last trough coming in well clear of the second from last peak. So under normal circumstances, certainly would be one to consider adding to a portfolio. Given market risk, perhaps less so inclined. Next one, POST, Post Holdings. Last week putting in a higher high and a higher low, so confirming a short-term uptrend, and at the same time also confirming the formation of a new medium-term trough. That medium-term trough is well clear of the second and third last medium-term peaks, and as such exhibiting really strong price action. So if we just zoom out and see where we are, you'll see that we are in fact at all-time highs. We don't have a lot of history on this stock. It's only around about 3 years old, but doing the right things in terms of price action relative to what the broader markets is doing as well. So the entry level for this one, on stop at $66.95 with a limit 1% above that level, $67.62. Protective stop coming in at $59.29. That's POST. Next one, THG, Hanover Insurance Group. Last week just eking out a higher high and a higher low, and as such confirming a short-term uptrend. And this one still has quite a bit of work to do to get from where it is up to that last medium-term peak. But nevertheless, it does tick the box in terms of our price action filter. Certainly had a lot of white candles over the last 2 or 3 months. Coming back with the broader market, but still hanging on 2 weeks ago to put in that nice bullish white candle. Last week, as I said, confirming a short-term uptrend. Where has it been? Certainly it's at all-time highs as we speak. So we just need to break that last medium-term peak. So the structure for our order is on stop at $83.32 with a limit to $84.15 with a protective stop at $75.11. That's THG. Next one on the list was THOR. I had a look, checked on Yahoo Finance to see if there was any news about this one, particularly with this very strong candle last week. Doesn't appear to be any news with this particular stock. Where's it trading at this point in time? Well, it's at all-time highs. The price action over the last few weeks, certainly we're putting in a shallow retracement there. We just need to break above that last medium-term peak. We need to put our protective stop certainly outside of 2 ATRs at the very least, and at least 0.5% below the last medium-term trough. So the order for THOR is on stop at $63.53 with a limit to $64.16 and a protective stop coming in at $58.96. Next stock, WTM, White Mountains Insurance Group. We'll just zoom out and see where we are in the broad scheme of things. All-time highs. So just zooming in and having a look at our price action filter, which says that our last trough needs to be at or above the second from last peak. It clearly is. I'll zoom in a little bit further. So after having this short-term downtrend, the trough formed by this pin bar candle only being confirmed last week, now that we have a short-term uptrend in place. The trough at or above that second from last peak. We just need to break through our last medium-term peak, and as such we have an on-stop order at $749.68 with a limit to $757.17. Protective stop outside of 2 ATRs and at least 0.5% below that last medium-term trough, coming in at $685.39. That's WTM. There might only be one or two more. SHEN, Shenandoah Telecommunications Company. So we'll just zoom out and see where we are. Again, we're in blue sky. So if we think about what this stock's done against the broader market, certainly relative strength been increasing of late when the market has been on a move to the downward side. And the last month's worth of candles, in fact probably the last 3 months worth of candles, actually being quite positive and therefore exhibiting outperformance in all 3 time frames. The last trough, which has just been confirmed by our short-term uptrend, coming in well clear of our second from last medium-term peak. We just need to break through our last medium-term peak here. So we have an on-stop order at $44.22 with a limit to $44.66 and a protective stop there at $36.59. So just in percentage terms, just have a quick look at that and see what it looks like. With a little bit of luck, if my calculator doesn't make the computer freeze. So I'll go and grab him and bring him over to the other side. There we go. Always worth it, just having a bit of a look to see what how far those stops are away and how much work it needs to do. So the difference between our entry less our protective stop, $36.59. is $7.63. Divide that by our entry price, 44.22, and we've got a pretty wide stop there. That's 17%. So you can see it's got a lot of work to do just to that's the difference between our entry level and where our protective stop is. So at the moment, where the price is, we're about halfway that distance. So we've got about 8 or 9% to get back up to that peak there, and then from that point of view, just to get to 1-to-1, it's got to put on another 17%. So it's certainly got a lot of work to do. But having said that, remember that the US market is certainly a lot more volatile than the Australian market. So it's certainly not out of the realms of possibility that could move that sort of distance in fairly quick time. The other ones on the list that came up, ASBI. The last few weeks, this has really just sort of been drifting sideways with a number of inside candles. We've only just started to put in a short-term uptrend, as a result confirming the formation of a new medium-term trough, which is well clear of our second from last medium-term peak, the one down here. Where has it been in the past? Well, now we are certainly in all-time high territory, so we'll just zoom back in and have a look at the structure of the trade. We just need to break through that last medium-term peak, and as such, an on-stop order at $23.51 with a limit to $23.74, and a protective stop coming in there at $21.03. That's a Mariana Bancorp. And I think K-Force, I think, is the last one that we might have on the list. Certainly not the most inspiring inspiring candle last week. We've had sort of short-term downtrend confirming now a medium-term trough with a short-term uptrend, marginally higher high, certainly higher low. The trough that's formed is certainly above the second from last peak. So as such, it does meet our price action filter in terms of where it's been. At this point in time, we're pretty much right at all-time high, so we've just got to break through these old levels. This old long-term peak here is way back in 1997, which is, what's that, about 18 years ago. Certainly time flies, doesn't it? So as such, from this point of view, we just need to break through that previous medium-term peak. The order becomes on stop at 29.35 with a limit to 29.64. Protective stop outside of 2 ATRs at the very least, and at least 0.5% below that last medium-term trough means that your protective stop is going to come in at $24.97, and that represents around about a 15% a stop loss in terms of distance. Kim says Thoratech was under takeover by St Jude for 63. Okay, all right. Thank you very much, Kim. Kim says that THR, which is the one that I was looking at, I couldn't find any information when I checked on Yahoo Finance, but Kim's suggesting that that there has been some takeover news there. Hugh says Board of Directors relating to the sale on July 22nd, Thorate and St Jude announced the signing of a definitive merger agreement. Okay, well, based on that and given what the is happened with, I will actually take that one out of the watch list. And so thank you very much to Hugh and Kim for pointing that out. That will certainly come out. And as Kim rightly points, the price action is very flat as a result. So thanks for pointing that out, guys. I'll certainly take that out of the watch list for this week as a pending setup. Well done. Questions, observations, comments for this particular week? I think it's certainly going to still be a volatile. I don't think we've seen the downside of this market just yet. A lot of things that are going on around the world as we speak. Employment numbers, etc., out of the US the last week certainly had an impact. The Dow down about 250, whilst that's not our primary market that we look at. If we just go back and have a look at our S&P 1500, just in terms, we're getting this reversal type of thing happening at the moment, and really, from a technical point of view, we're really now getting down to these sorts of levels where we once had some support. We've come back up. We failed at that level. We've had another test. We failed again. Towards the downward side, where could we go? Well, certainly in the short term, we're looking at around about 435 thereabouts on the S&P 1500. If we happen to zoom out further than that, that's probably the first target. If that happens to fail, then next key levels are down around the 420 level. We really need to see some strong price action over the next few weeks. Certainly the volatility is at very, very high levels, and that's and you'll see that through, if you have a look at the volatility index, you'll see that in the pricing of options, etc., which certainly is a component of the volatility index as well. Let's have a look. See whether there's any questions or anything. Kim says, fully aggressive Casey on stop. Okay, let's go and have a look at Casey. Casey is already in. I think Casey was Casey in. I keep getting muddled up with Casey General Stores and Dollar General. We'll just bring up Casey and have a look in your own time beyond charts. There we go. Okay, so the aggressive trader, says Kim. Yeah, look, unless I've got missing some data at this particular point in time, we've just got, at this point in time, we've still got inside count of the last one there. We've got work to get above, certainly 100 and 110 at that point in time. Certainly wanting to trade when we've got all three trades in alignment. So I really like to see the short-term uptrend first and foremost. So we've got all three in the all pointing in the right direction. Certainly at this point in time, not rushing out to put on any aggressive trades at this point. But certainly Casey's been behaving itself reasonably well, given what the broader market has been doing. Ken says AF. Let's have a look at AF. Astoria Financial Group. Let's bring that one up. Let's put on our overlay. Let's put on our price action. Yeah, certainly in terms of price action, Ken, we've now got a short-term uptrend being confirmed. Last trough at or above second from last peak, absolutely. Let's zoom out and see where we are in the scheme of things. Right, so what we have at this point in time, we do have, you can probably see it here, a level on the chart, which is a long-term peak. It's a major point of supply. It turned this, what was through there, a long-term uptrend and medium-term uptrend, turned it completely all the way around. So we must give it some respect. So let's just zoom in and see whereabouts we are, and it's just above that level. So this was one that did actually come up on the scan, so well picked out, Ken, in terms of price action. Just needing to zoom out and see what's overhead. That's the only thing stopping this one at this point in time. Once we break through there, then it's a different kettle of fish, but it's certainly at this point in time got that overhead resistance just too close, and that's going to invalidate the trade set up on that basis. Only Ken. All right, well, if they're... And Ken says, I just wanted to show I did my homework. Well done, Ken. Keep doing your homework. That's the way you get better at doing things, and certainly these markets are the best opportunity to learn. It's very easy to think that you are successful in your trading when the market's low in volatility and everything's trending along very nicely and slowly, and putting capital into your, putting hay in the shed, putting capital into your bank account or your trading account. But as I keep saying, smooth seas never made a competent sailor, and these are the sorts of the markets that you will learn a lot about yourself and your ability to stick to your trading plan and manage your risk. You know, the markets aren't always going to be like this. Certainly, I think you'll benefit from the experience. Sometimes it's a costly experience, but it really is a test of how well you follow your trading rules and how committed you are to the overall process. So hang in there, keep following your rules, manage your capital. We don't have any control over the markets, but we do have control over how we react in the markets. Well, that's it from me this week. I'll try and get a educational webinar out on Wednesday afternoon if I can. I do have a couple of workshops to run this week, so time permitting, I'll certainly try and get something out for this week. But certainly, if not, we'll catch up at the macroeconomics analysis session later in the week and next Monday for the weekly analysis session. So bye for now.